Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids resource for a common sense approach to planning for our financial, our investment, and our retirement planning lives. He provides us the guidance and insight that we need in order to make well thought through and informed decisions. He is founder of Cornerstone Retirement Partners, Ron Corser, CFP. And Ron, we always appreciate the information and education.
Well, good morning, Peter. Good morning, everybody listening to today's program. Welcome aboard. We're going to have an interesting conversation today about retirement. And I know that's on everybody's mind, whether you're 33 years old or 93 years old. It's always a question of when can I retire? What do I have to think about? What are the pit holes? What are the things that just going to go out there and look out? Those kinds of things. So we're going to cover a lot of that today. But I want to encourage everybody, those of you who are driving to church this morning, bless you. I hope the Lord really pours out His Spirit upon you. And for those of you who are listening to today's program, if you want to go back and listen to today's program, if you're a note taker or you just want to make sure you've covered things that you may have missed, is go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there and we'll reach out to you if you have questions. But you can just download today's program and all our previous programs to get the information you need to make really good decisions with your financial future. So today's program is titled The 5 Biggest Risks to Retirement Going Forward. And I know a lot of people right now are saying, what do you mean, there's just 5? I think there's more like 55. And I understand it, I really do. But we're going to cover some of them. And what are they? Number one is something called longevity. That's living longer than you plan to live. Number 2 is volatility. What's going on in the market? We're experiencing that now. Number 3 is inflation. That's been with us for a while, and it may be with us for a lot longer, certainly potentially longer than what some of the politicians are telling us. 4th is taxation. That's going to be one of the biggest costs in retirement that we face. And finally, is longevity. Scratch that. And finally, the 5th one is legacy. And legacy, yes, it concerns leaving money to future generations, keeping your hard-earned retirement dollars in the family. Most people want to do that. Some people have, they want to do some gifting, and that's fine too. But I've never met anybody that says, you know what, when we pass away, we just want the government to take all the money. So the question becomes, how do we manage all of this from a legacy point of view? And we'll touch on that. So again, if you have any questions or you want to just give us a call at 616-301-2581, 616-301-2581. We'll help you with whatever you need. We'll give you the information that you need and the information really that will clear up some things in your financial future that'll help you make a really great decision going forward. So give us a call at 616-301-2581 or go to our website, www.cornerstone-rp.com. Put your information in and we'll reach out to you and help you.
Always a lot of fantastic resources, tools, calculators, reports, information on specific topics available on that website, cornerstone-rp.com, cornerstone-rp.com. Cornerstone Retirement Partners, ladies and gentlemen, your proactive planning resource if you have questions or concerns about your financial investment and retirement future. Give them a call, 616-301-2581, 616-301-2581. Ron, I always think it's helpful when we have kind of articles like this that cover several different concerns from a high level, but I know in each one of these 5 topics and these 5 risks to retirement, we probably could have a series of several conversations, several shows to discuss what to do, what to understand, how to address these in the planning process. So we do keep it at a generally high level here on the program, but that is like what the next step is all about. And I think the true benefit of this program is that you are a real human being. You are accessible to listeners. They can give you a call and they can come in and address these areas and topics of concern if they would like.
Yeah, they can. And I welcome everybody to do that. Our job, as we see it, Nolan, who's the managing director of our company, and myself, is to help people, to be a resource for them, to give them the best possible guidance and direction. Because we've got some adventure coming down the road. We all know that. Intuitively, we know that. So what's the best way to deal with all of this? And that's what we're going to touch on here today on this program. Because these 5 topics are real big ones. We can do a show on each one of them, and maybe 3 shows on each one of them. So we'll kind of go from a 30,000-foot view down to a 12-foot view to help people out as best we can. So again, if we've touched kind of a nerve in your existence there, give us a call at 616-301-2581, 616-301-2581, or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. You can find today's program in there and all other programs that we've been doing for several years now. So look forward to hearing from you. Look forward to being able to help you.
Ron, sometimes we don't see or hear certain information. It's almost like we can ignore it or it doesn't exist until we're exposed to it. It's like it's just not part of our ecosphere or our universe. And then suddenly we are exposed to it and we begin to pay more attention and then see and hear about it everywhere. It's kind of like that thing that just once you get a little exposure on the internet to something, it seems to follow you around and you see ads for it everywhere. I guess they're the cookies that websites track and then can display ads, but it's like that in life too. We have no knowledge of a topic, and then we have a conversation about that topic, and then suddenly we hear conversations about that topic everywhere. And I think that these 5 biggest retirement planning challenges are like that. Each one of these seem to be that kind of subject that maybe we weren't really all that in tune to until we are. And I know as a financial planner, advisor, as a CFP certified financial planning professional, it's your job to be in tune with these. So you have these conversations each and every day. And that's why it's kind of important that you bring them up on this program. Longevity, something that we all hope for. We sort of understand that our lifetimes and lifespans are growing longer and certainly longer than they were a decade or 2 ago. But I'm not sure that everybody fully understands the impact of that from a financial standpoint and a retirement planning standpoint. And certainly at some point in our planning progress, we've got to have some specific conversations about this. And it'll probably be enlightening to a whole different way that we need to look at longevity.
Yeah, longevity. What in the world is that? Most of the topic that gets beat around the bush, so to speak, in our industry is you hear people say the number one fear of people in retirement is running out of money. And that kind of points to the idea of longevity. What is longevity? Longevity is 2 things. Number one, it's living longer than you planned. And that can be a problem. But number 2, what really longevity is it's a multiplier of all the other risks that you could potentially face in your time in retirement. What do I mean by that? Well, if you live long enough, what are you going to experience? You're going to experience financially good stock market stuff and bad stock markets. You're going to have good times with your health. You're going to be healthy and you're going to go forward and enjoy retirement. And there's going to be, as we age, we're going to run into some health issues. Every one of us does that. So longevity or living a long time is a multiplier of the risk of the government taxing more of our money, the risk of being sicker than we planned, the risk of living longer under maybe some stressful situations than we had hoped for or planned on. But it's one of those things we have to have a conversation on, and everybody should be, I call it blessed to have somebody to talk to you about it, because it's one of those things that you really need to handle you need to really focus on in the whole retirement financial world. It's just there. So somebody could be retiring, a couple could be retiring at say age 65. They get into the Medicare system, and then they think, well, we could, we can live another 15 years. That'll be fine. But what happens if you leave another 25 years? There's some interesting statistics out there that says, a guy who lives to be 65, you have about a 1 in 3 chance for men to make it to age 90. 1 in 3 chance to make it to age 90. And that means if you make it to age 90, you could make it to age 91 or 92 or 97. For women, there's a 50% chance, a 1 out of 2 chance, when you hit 65, that you're going to live at least age 90 and maybe longer. So what does that mean? What does that really break down to when we think about retirement planning? Number one, we have to figure out how to structure your life savings, everything you've saved and worked so hard for, and how to put it into different, what we might call buckets, to provide you all the income you need in retirement. And that obviously has to increase over time. Part of the longevity problem that we need to solve is what kind of accounts should we use? And that gets into a wide world of discussion, because the accounts that we focus on are accounts that are available to everybody. What we try to make sure is that, number one, you understand what the options are, because what's the key to successful retirement planning? To have as much permanent guaranteed income in retirement as you can possibly muster. So if the day before you retire, and we talk about this on just about every program, if you can have all the income that you need in retirement to do what? To maintain your lifestyle. You can have all of that money coming in and be able to adjust it upward, because there's things called inflation. You've done a really good job in retirement planning. And we strive to help people understand that the most successful, the most solid retirement income plans in retirement have at least 4 sources of a predictable income. What are they? Well, Social Security is one, right? You get past 62, some point in time between 62 and 70, you claim your Social Security benefit. A second one could potentially be if you've worked for an industry or a company that has a pension program. That's another form of guaranteed income, predictable income. A third source could be you create some of this permanent income by adding an annuity concept to your portfolio. What do annuities do? They do something that nothing else can do, and that's really give you a stream of income throughout, no matter how long you live, throughout your lifetime, that you can't outlive. So that's the third one. Where's the fourth one? Well, how about your life savings? You can certainly take money out of your IRA account on a monthly basis. And fifth one might be you have a rich uncle in South America that has a diamond mine, and he's going to leave that all to you. So you're going to inherit all of that. But if you can create 4 streams of income, you have a really good chance of being very successful in retirement, because the longer you live, the more you're going to need income to live on. A lot of people think, well, my wife and I are in pretty good shape, but if one of us passes away, well, we only need about half the income to live on. That simply is not true. Why? Well, think about this. The cost of groceries doesn't go down. You may buy fewer gallons of milk, but the cost is still there. Taxes don't go down. Real estate taxes don't go down. You're not going to get a note from your gas company if your spouse dies saying, we understand that your spouse died, so we're going to cut your gas bill in half. That probably isn't going to happen, although sure, it'd be a nice thing to have happen. So the cost of living doesn't get cut in half. It's still in many ways out there. And the other way that it comes back to kind of get our attention is that all of a sudden the surviving spouse has to file their taxes as a single person as opposed to a married couple. And that can be a real financial burden on some people. So living a long time, this issue called longevity, is number one, a multiplier of all the other things that could impact your well-being in retirement. And number two, that if you don't plan for long enough retirement, you could run into a wall and literally not run out of money, because nobody ever does that, but have to cut down your lifestyle in retirement so that you make your money last. And that's probably not a good option for people. So if you hit this topic head on while you're doing the retirement planning, while you're creating your retirement income plan in retirement, you'll be more successful and potentially have a higher probability of success in retirement than if you just assume, well, nobody in my family ever lived past 70, so I'm not going to worry about it. You could be the one that lives to be 97.
Yeah. Genes give us some indication, but only tell us so much. And we are living longer, even with health issues that could potentially plague us. We are still living longer thanks to modern medicine sometimes, despite those various health conditions. I find it interesting you call longevity the multiplier of other risks. Ron, if we live 5 years versus if we live 35 years in retirement, the likelihood that inflation is going to be impactful significantly increased. The likelihood that we will see not only one, but multiple different business and economic cycles dramatically increased. The likelihood that rules and laws and taxes dictating how much of our money we get to keep significantly increased. And I think that is the thought process behind calling longevity the risk multiplier, correct?
It is correct. And the number one objective in retirement planning is to take the risk of longevity risk off the table. And how do you do that? In the simplest form, you create as much permanent, predictable income as humanly possible from all sources available to you, so that every month you have all the money you need coming into your checkbook to pay your bills, to enjoy retirement, to do some fun things, create memories with your family. The most successful retirement planning people, meaning the individuals who retire today, their chances of success are absolutely just, you're going to go to almost 100% if they can take the risk of longevity off the table. And that's a clean and clear planning objective. And we do that. We always focus on how do we make sure that if God lets you live to be 100, you're still going to have the money you need to pay your bills and do whatever it is you need to do or have to do or can do so that you can get by day, enjoy life in the best way possible. Taking longevity off the table, planning for it, consciously doing that is one of the single most important things any advisor can help you do, and we help you with that. So if this is of interest to you, please give us a call at our office, 616-301-2581. 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and give you the help you need, provide the information you need, so you can make really good decisions for your family and your retirement future.
And if I am trying to put together as sound a financial outlook as possible, Ron, I can make some assumptions about my longevity, about my lifespan, but there are two sides to that. And if I am wrong about that assumption, I need to carefully examine the impacts of that. In other words, if I assume that I'm going to live to 121 years old and then I don't make it, I go before that. I am wrong about that assumption. What impact does that have on myself and my loved ones and my beneficiaries? Whereas if I assume that I'm only going to make it to, say, 72 and spend my money as such, and then I am wrong and I end up making it to 92 or 102, what impact does that have on myself and my loved ones and family and beneficiaries? I'd rather be wrong on one side of that assumption rather than the other.
Absolutely. Absolutely. You know, as I said earlier in the program, in our industry, we seemingly always talk about the greatest fear of retirees is running out of money. That, to my point of view, is not the greatest fear, although that covers it. The greatest fear is having to adjust their lifestyle in retirement for any number of reasons, so that they can't enjoy retirement like they had hoped to. That's the tragic part. Living too long is not a problem if you've planned for it. If you just assume, my wife and I joke with people, but I really mean it. I pray that I live to be 100. And I also pray in the same breath that I pray that if I live to be 100, that I know I'm 100. Because it seems to me being 100 but not knowing it is not really much of a good deal for me. But we plan on that. I plan actually in our life of living to be 100. And our financial plan, if and when we ever choose to retire, is based on that. And people say, well, I don't want to live that long. But what if you do? You know, do you really want to be in a situation where you're living out of the back seat of your car when you're 98 years old? That may be a bit of an exaggeration, but you know, nobody wants to be caught short in retirement. So one of the key things is take longevity off the table, and you do that simply by creating streams of income that will last your lifetime. So if we go to number two is something we're experiencing right now, aren't we? Volatility. What in the world is volatility? That's when the stock market goes up, down, sideways, does goofy things that you think, why is it doing that? There's an expression in our industry that says the stock markets can remain insane a lot longer than you can remain solid. And what does that mean? It just means that for those of us who want to keep a portion of our life savings in the stock market, we have to be prepared for volatility. It's there. And it's a real risk because it's the up and down stuff that can make a big difference in your life. Think about this. Let's pretend you have $500,000 in the stock market in retirement. And you've created a retirement plan that balances the risks and volatility and all of that large cap, small cap, baseball cap stuff. Well, the risk of the market going down is substantial. And it's part of the longevity risk issue. But that happens, I mean, the market doesn't go down 30% every other year. But what can happen is we go through extended periods of time where the market doesn't do much of anything. It just stays relatively flat, goes up a little bit, goes down a little bit. Maybe it can last a year, it can last 10 years. We've had those kinds of periods where the market has been generally level and flat. We've just dealt with a lot of volatility. And that's a risk that we have to kind of take off the table. How do we deal with that? In the simplest form, as an investor with your retirement money, you have to be able to assign some level of risk to your investment strategy. Now, there's two ways to do this. In our industry, you could come in our office and say, Ron, here's my portfolio. How much risk is there in that? And if we created the risk for you, I could say, well, there's not too much. And then a rational response to that would be, well, not too much. Does that mean if the market corrects and goes down, I'll lose 5% or 55%? See, a lot of times in our industry, people are given the answer of not too much. What we try to do this a little different. There's ways to measure risk and volatility. You can actually measure with bonds, with stocks. And so we try to do that with everybody that allows us to help them create a retirement plan. I'm not one of those guys that think not too much is a good answer to how much risk you have or how much money you lose. Put it this way, if you had $500,000, I could say, well, you don't have too much risk in your portfolio. Don't worry, be happy. And you might accept that. But how about if I said, with your $500,000, 500,000 in the market, if the market goes down 10%, you're going to lose $50,000. How would you respond to that? That really gives a different perspective on volatility and how you manage risk, because managing volatility is really trying to manage risk in your investment strategy. See, it's a whole different animal what we're doing now. Not too much. I guess we can live with that. Losing $50,000 in my portfolio, no, I can't live with that. So that's a real clear-cut decision that you have to make along with your advisor. And it's a decision we help our clients all the time handle. So if you want to know how much risk you have in your current portfolio would like an evaluation, we can give you that evaluation. We can show you statistically by the numbers how much risk you have. So give us a call if this is important to you. Give us a call at 616-301-2581. 616-301-2581. The reason I make this offer is because this has been a really volatile year. We're in negative territory in this year. And a lot of people that we've met for the first time have listened to this program or come to us when they've been family member, maybe says, go see Ron or talk to Nolan. They're surprised at the kind of risks they have in their portfolio and also the losses that they've experienced. So if this is important, if you want to know how much risk you really do have in your portfolio, stocks, bonds, mutual funds, give us a call at 616-301-2581, or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and provide you whatever it is you need so that you can make really good decisions for your family going forward.
Talking about the greatest risks in retirement, the biggest challenges, 5 challenges specifically that we are discussing so far. Talked about longevity and the additional risk that exposes us to, and how we can think of longevity once again as something that we hope for rather than a risk to our financial status. And one of the big ones that's on everybody's mind, especially after a year or start to the year like we've had so far, is volatility in the market. And these are risks, ladies and gentlemen, that you must address in your planning. You must have an approach. You must have a conversation with an experienced, qualified professional in order to understand how you have specifically addressed each and every one of these items. We'll continue on with the conversation, talk about the 3 remaining risks when we come back after the break here on Your Course to Retirement. If you would like help and assistance in your planning process, pick up the phone and give a call to Ron Courser, CFP, and the team from Cornerstone Retirement Partners. 616-301-2581. That is 616-301-2581. Quick break. We will be back right after this. And welcome back into the program. This is Your Course to Retirement with Ron Courser, CFP, founder at Cornerstone Retirement Partners, your resource, ladies and gentlemen, for a common sense approach to planning, for perspective, guidance, information, and education on your financial, on your investment, on your retirement future, and how to specifically address the plans to achieve your individual unique goals into and throughout that retirement future. They are the team from Cornerstone Retirement Partners, Grand Rapids, a resource for you. If you would like to sit down with Ron Courser, CFP, and the team from Cornerstone Retirement Partners, pick up the phone and give a call, 616-301-2581. That is 616-301-2581. Now, today on the program, we're talking about the 5 biggest challenges that we face during retirement. Number 1, longevity. Number 2, market volatility. Ron, we really tend to think of risk as kind of something that is absent and separate of reward and growth. We understand the saying, you have to take risk in order to get greater returns, but we tend to focus on the positive side of that until we have a down economy and a down market. You actually help your clients quantify their risk level and risk exposure, something that sort of seems ambiguous in most financial conversations. You don't have much risk. You only have a little risk until the market's down and we see it's more than we were comfortable with. You help people kind of assess and have realistic expectations of that ahead of time.
We really do. It's part of the planning process for retirement planning and producing the income you need in retirement. We spend a lot of time on risk. We think it's that important. Yes, everybody wants growth. Everybody wants to have, increases in their value of their portfolio when the market goes up. But what about the other part of it? What happens if the market doesn't go up or it actually goes down? Then what? So we spend a lot of time really digging into the kind of risk that a potential client coming into our office might experience in their current portfolio. And is that risk, is it okay with them? Is it really okay with them? Do they understand the risk? You don't have to be a rocket scientist to understand a little bit the kind of risk you're exposed to. And we try to make that clear. And we try to say, are you comfortable with this level of risk? That's why we try to put numbers to it. We quantify it. Instead of saying you don't have too much risk or you have a little too much risk, we actually try to put numbers to it because that we think gives you the best understanding of what might happen to your life savings. Because remember, we're dealing with your life savings here if the markets don't do what you want them to do. So in dealing with inflation, how do we do that? You know, historically, everybody who's ever written a book on Wall Street and investing has said the best way to stay ahead of inflation is to invest in a good group of stocks or mutual funds. Stay invested in the market. My response to that is, yeah, that's kind of a good idea, but understand the downside to that mentality. You can have a portfolio, all your retirement income can be in the stock market. And when the market's going up, you're staying ahead of inflation, you're doing really well. When the markets don't go up, are you staying ahead of inflation? So here's a key question. For those of you who have looked at your portfolio this year, if your portfolio is down 15% this year, key question. And we know inflation is around 8.5 or 9, depending on how the bureaucrats want to measure it. So if your portfolio is down 15% this year, year to date, and inflation is around 8.5 or 9, have you stayed ahead of inflation? Have you stayed ahead of inflation? You've lost money in the stock market, and inflation has increased, some might say catastrophically, but it's going up. The cost of everything is going up. So have you stayed ahead of inflation? When I pose that question to people, sometimes they think about it for a minute, they ponder it, and then they realize, no, if I've lost money in the market, even if inflation is 1%, I haven't stayed ahead of inflation. So then sometimes people say, well, the issue is a long-term one. You have to take a long-term look at the markets and everything like that. Because on a long-term basis, the market always goes up. And that's true. You just have to live long enough to experience it and struggle through the times when it isn't. So why is this issue of inflation important? It's something that we really can't control. Believe it or not, ladies and gentlemen, I don't have any control over inflation. Believe it or not, ladies and gentlemen, I don't think the government has any control over inflation. They've created it. They've let the tiger out of the cage, and they don't know how to put it back in. So we have to deal with it. So one of the ways we can deal with inflation, number one, based on what I've just said over the last few minutes, is have a plan in place that you did before this ever became an issue. Have a plan in place to minimize the potential of a significant downside loss in your life savings and investment strategy. That's number one. Minimize the downside losses. Number two, and this goes back to the longevity issue, create as much permanent, predictable income, because it's income that we spend. We don't spend rate of return. You know, just because maybe last year your rate of return was 12%, that really doesn't tell you how you're spending money. You spend money based on your income plan. And the key to dealing with inflation, one of the keys, is to make sure that if inflation keeps going up, your income, what you've already created, those streams of income, hopefully you have 4 of them, maybe 5, doesn't go down. So those are 2 things we can do with inflation. Now, if inflation goes back to Jimmy Carter days of 14 or 15%, it's going to be very difficult to manage that for anybody because it was difficult back then. The difference back then is not nearly the number of people who were in the market then as they are now. There's more in the market now. We didn't have 401ks back in the beginning of the 70s. Those came in the beginning of the 80s. And eventually people got more invested in the market. So 2 things are dealing with inflation. Number one, create an investment strategy that gives you the best probability of success to minimize stock market losses. The second thing is to create an income strategy that gives you the money you need in retirement. And if inflation goes up, can somehow be adjusted somewhat in retirement. That's one of the really hidden advantages of annuities. And I'm going to just kind of touch on that for a moment. Annuities are like a four-letter word in our industry. Some people hate them, some people like them, some people don't understand them. It depends on who you're talking to, is probably how you hear about it. But here's one thing that annuities do that no other kind of account can do. They can provide income to you for as long as you live, guaranteed. Think about that. You can use an annuity to provide income that you'll need in retirement for as long as you live. And some of these can actually be adjusted for inflation, so to speak. So they can actually go up in value over time with the income that you're taking out of them on a monthly or annual basis. So there's three solutions here potentially for dealing with inflation. One, minimize your downside potential to lose money in the market. Number two, create as much permanent income as you possibly can that doesn't get impacted by whatever happens in the stock market. And three, be open-minded about this thing called annuity, because it does something that nothing else can do. If you have an account with Vanguard or TD Ameritrade or Schwab, and that account goes to zero, you're probably not going to be able to take more money out of that account because there's no money left. But with an annuity, that annuity properly set up and created for income, even if that account goes to zero, they will continue to send you money. Now, I know for a lot of people that may sound like, oh my, that's too good to be true. No, it's not. We can show you how it works. That's as much as I want to do on this program, but that's how to deal with inflation. Is it a perfect solution? No. If we run into 17% inflation, there really isn't any perfect solution. We just have to figure out how to survive.
Ron, how much is inflation and then the last topic we talked about, market volatility, interconnected? I remember back in the late 70s, early 80s, inflation was high. The federal government, the Fed, took a similar approach to trying to calm it down, rising interest rates, raising those rates, and the market reacted with a pretty significant decline, bear market recession for an extended period. And it seems like we are echoing kind of that time and those conditions, except that right now we have more people in debt compared to back then. More people actually benefited from the higher interest rates back then because there was more savings. And as you noted, the 401k wasn't really incepted and widely adopted until the mid to late 1980s. We have more people with personal investment and their life savings on the line with the market volatility that we are experiencing than what we did back in that time period.
Yeah, ultimately, high inflation is not good for the stock market. Simply isn't. What's the success ratio of dealing with inflation? Not real good from a government point of view. But let's go back. Let's take the Wayback Machine, right? And go back to Ronald Reagan and when he took over, we had inflation in the area of 14, 15%. How did they fix it? Paul Volcker came out and raised interest rates to 18%.
Very, very steeply, very suddenly.
Very quickly, yeah.
Very
so what did that do?
Yeah.
It did a couple things. Number one, it did ultimately kill inflation. It worked. Inflation in about 18 months went down, back to normal low levels. But the other thing it did, it created a really severe recession in our country. And the stock market was uglier than you can imagine. So it's like a two-edged sword. We have inflation, which impacts our lifestyle. To fix inflation, it's going to impact our lifestyle. And we can only hope that all that high-priced talent in Washington, D.C. tries to figure out a way to do it, but it's very difficult to do. So it really comes back to us. I always assume in my own life, and I do for our clients, that the government really isn't going to take into consideration our needs. They're going to do whatever they think is best for their needs. So how do we deal with that? We deal with that by making sure that we do the very best job we can in creating a strategy that will minimize the downside potential losses, that will give us on an ongoing basis, high inflation, low inflation, whatever, the income we need in retirement to remain retired and to hold on to our lifestyle as best as possible, and then create streams of income from accounts that have principal protection, like a fixed annuity with streams of income that actually can increase over time. So those are the things we can do to deal with inflation. It's not so much as sitting back and saying, well, I think inflation is going to go away eventually. You're right, it probably will be, but it's not going to go away tomorrow. And it's not going to go away next month. Our inflation rate in this country is not going to go back down to 2% by Christmas time, and unless we have a major ugly event in the economy and the markets. And I don't anticipate that. So we've touched on 3 issues now. And if we've touched kind of a soft spot in your heart or a place in your nervous system that you want to talk to somebody who can help you deal with longevity, living a long time, creating a plan for that, market volatility, we're knee deep into that already. Some people think we're up to our eyebrows in it. And inflation, give us a call at 616-301-2581. That's 616-301-2581. Or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you in whatever way you need help.
Again, the team from Cornerstone Retirement Partners, your resource, ladies and gentlemen, they're available for you to have these conversations, formulate your plans. They do offer the course to retirement, the proprietary plan that you can get put together there, working hand in hand with qualified, experienced professionals, Ron Corser, CFP, Nolan Gosley, and the team from Cornerstone Retirement Partners. They will help you to address these 5 biggest retirement challenges in that plan and formulate the written retirement income plan along with you. If you'd like to take advantage of that, it is a complimentary extension of the information provided here on the program. The real value of the show is that you can get that plan put together and have personal individual planning reviews and strategy sessions with the team from Cornerstone Retirement Partners. If you'd like to take advantage, all you need to do is pick up the phone and give a call, 616-301-2581, 616-301-2581, 616-301-2581. Ron, this next item on the list, one that we really cannot do anything about as far as avoidance. We don't want to, because then we might get in trouble, but we can do some management, taxation. You mentioned at the start of the program, probably our largest known expense in retirement. We need to do what we can to keep more of our money for our own purposes and manage and reduce the tax liability and expense that we have where possible.
Yeah, the tax issue is really, it's that 800-pound gorilla in the living room kind of an issue. Sometimes we think we can't deal with it or we can't handle it. We just got to go along with it. My response, that's not always true. Let's just step back for a minute and talk about taxation and the government's need for tax dollars. Number one, those evil 1%ers that we keep hearing about in the news that have all the money on earth. If we just took their money, all the basketball players, Bill Gates, Warren Buffett, all the hedge fund managers, forget about taxing their money, just walk in one day into their house and take their money. We don't have enough money to run our government for a year. Now think about that. We keep being told by politicians that we'll just tax the rich and that'll fix anything. That's not exactly accurate. Here's the second point. Most of the money in retirement accounts are with the middle class. Most of the money with retirement accounts are in the middle class. Depending on who you listen to, there's anywhere between 22 and 27 trillion dollars in IRAs, 401ks, stuff like that. That's where the big money is. That money has never been taxed. And every time a dollar walks out of one of those accounts, it gets taxed. Now, here's the third point. We heard in the news that we're going to hire another 87,000 IRS agents. There's also, so, if we're just going to go after those evil 1%ers, there's more than enough agents right now to do that. But there's even going to be more if that's all they go after.
I heard that is something like an average of about 25 to 30 per county across the United States.
So guess what? Here's the ugly, dirty little secret. They're coming after the middle class. They have to, because that's where the big money is. That's where they have to come. Now, there's also reports out there that the IRS is arming some of their agents. So that doesn't bode well for the future. So we know that taxes ultimately are probably going to go up. If people don't believe that, then this next year or so, when we start to see the impact of those 87,000 new agents being brought on board over the next 10 years, well, it should prove it to us that it's going to go up. The government's spending more money than they can shake a stick at. They need more tax revenue. They're not going to get much more out of the wealthy 1%ers because they're already doing everything possibly to do. So they're going to come after the middle class, us what I call us normal folks. So what can we do about it? Well, part of retirement planning, and even now, for people who are 25 years away from planning, one of the best, and this is free advice for those of you listening on a radio program, and because it's free, you don't have to take it. One of the best things you can do is start to put money into Roth IRA accounts, either through your 401k or 403b, your employer provider, or you just open up a Roth account right now. Think about this. As a couple, as long as you make less than $203,000 a year, you can put $7,000 a year if you're over 50, or $6,000 a year if you're under 50 per person into Roth accounts. Why would you do that? Why would you do that, especially knowing that your tax preparer is going to tell you that you're going to pay more in tax if you do that this year, as opposed to putting more money in an IRA that's tax deferred? Why would they tell you that? Because it's the truth. You're going to pay a little more in tax. But here's the long-term truth. If you're going to be a long-term investor, doesn't it make sense to be a long-term manager of your potential tax liability? Seems to me they go together hand in hand. So if you start creating Roth money, tax-free money today, even if you're 30 or if you're 65, it doesn't matter. If you plan on living in retirement more than 10 years, or if you're 30 years old and you're trying to save for retirement, and even though you want to minimize what you pay in tax, it still makes great sense to create accounts that will ultimately give you tax-free income when you get ready to take it out. Now, here's the other part about wonderfulness of Roth IRAs. They have some different rules to them. One of the things I always tell people, because a Roth IRA is one of my favorite go-to accounts as a financial advisor, is if this year you have the ability to put money into a Roth IRA. Let's say you're 30 years old, you can put $6,000 a year into your Roth IRA. Here's the real secret to this. You can always go back in legally and take out what you put into that account. What does that mean? If you put $6,000 a year, if you're under 59 and a half, you put $6,000 a year, or 50 rather, into an IRA, and you got to take that money out, you're going to be taxed on it, plus you're going to pay a 10% early withdrawal penalty. If you put that same $6,000 into a Roth IRA account, you can go back in tomorrow morning and take what you put in out. You have to leave the growth. So it's actually a more liquid account. You can invest in just the same things in an IRA, and you can manage your portfolio the same way, but there's more availability to your money. It's what we call more liquidity. So that's one of the ways to do it. A second way to do it is, if you have a taxable account, is to figure out what kind of investments you're using. Generally speaking, mutual funds are less tax efficient than something called an exchange traded fund. So it's important that you have a conversation with your advisor. And if you're our clients, you want to come in and talk about it, we'll have that conversation, explaining the difference and explaining what a potential tax advantage is versus an exchange traded fund or a mutual fund. So there's ways to minimize the impact of increasing taxes on our life savings. Now, think about where we pay taxes and where we have very little control, if any. We don't have any control on the sales tax. We have very little or no control on real estate taxes. We don't have any control on a whole bunch of other taxes. So the taxes we can control are the taxes that are generated from income we earn, but both wages, W-2, and also investment income, and how we manage those taxes. So it's really important to do that. I tell people really clearly, if you think you're going to live longer than 5 days, put money into tax deferred accounts that are going to produce tax-free income, and those are Roth accounts. So it's really a key piece of free advice, ladies and gentlemen, that you don't have to take. If you'd like to talk about or have a conversation about how we can create that kind of an account for you and what the impact might be 5, 10, or 25 years from now, please give us a call, 616-301-2581. That's 616-301-2581. We'll reach out to you and help you and schedule a time for us to have a conversation by phone or in person. Absolutely no cost. And I call them no stress-free times because we'll just talk about what you want to talk about. Or you can go to our website, www.cornerstone-rp.com. Put your information in there, www.cornerstone-rp.com. Say, Ron, I want some information on Roth IRAs. I want to know how they work. And I need to know all about that tax issue. We'll help you with that. We'll help explain it to you in a way that's clear, in a way that's easy to understand, in a way that it could make a really big difference in how you succeed going forward in your retirement life.
Ron, I know you are a big believer in the concept of the Roth 401k and Roth IRA, but there are some times where you need to proceed with extreme caution and where it may not be right. You've talked about, for example, if somebody's got a $500,000 IRA, they're probably not, it's not recommendable to convert all of that to Roth all at once. This may be a strategy that plays out over a number of years. If somebody is going to be significantly dropping income in retirement, if that is foreseeable, that they are a high income earner now and will be living off of significantly less in just a few short years, may be a time to proceed with caution. But this is all in the strategy. This is the tax management. This is where we have the ability to control our taxes that you walk your clients through in that planning process and when designing that course to retirement.
It's a situation where it's unique to each individual couple or individual person. And obviously, just to take a look at that, you got $500,000 in your IRA, you certainly are not going to convert all of that in 1 year. I have interesting conversations with our clients' CPAs, and even with our own CPA, that talks about is a Roth IRA really, does that make sense? And what I tell people is, generally speaking, if you think about tax preparers, what's their job? Their job is to minimize what you pay in tax, and they're really good at it. I mean, absolutely good at it. So the idea of saying, I want to create a strategy where I'm going to pay more in tax this year and next year to create some tax-free income down the road, sometimes is a hard lift for some of the tax preparers to come through. So I always caution people that we'll work with your CPA or tax preparer, or we'll use our own to help you. Their bias is really to not do so much of that, if any of it. My bias is really pretty obvious, I hope, from what we've talked about. I'm a big fan of Roth IRAs. My wife Nancy and I have been using them for, since 2003. So, and I'm very happy with it. I paid a price for it. I paid a price to have money there that's going to be tax-free going forward. But it's a price that I thought was worth paying, even though my CPA at the time thought I had lost my mind because we converted a lot too. But I'm very pleased with it now. So it's a discussion we have, and it's always unique to the individual. And the individual always has a right to say, nope, I'm not going to do that. I simply don't want to pay the tax today. And that's a good decision. Our job is to give you the options so you can make good decisions. So if you'd like, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you, and we'll have a really great discussion. And that's what it is, a really great discussion of basically is creating some tax-free income for you down the road. Does it make sense for you? Is it something you want to do? And is it easy or hard to do? We can help you answer all those questions. So give us a call, 616-301-2581.
Ron, just a minute left and probably time for only a word or two on this final challenge. Number 5, leaving a legacy for family and friends. Bottom line, if you cover the first 4 challenges, your likelihood of leaving a positive, impactful legacy behind are dramatically increased.
Yeah, they really are. You know, if you do the first 4, manage it the best you can, chances are when God calls you home, you're going to leave a little money behind that can be kept in the family and spread out the way you've decided to do it. There's a lot of ways to approach it. We're probably going to do a program coming up shortly just on the whole idea of how do you deal with the healthcare issue going forward in retirement. It's a really big deal. We're going to talk about that. My wife, Nancy, is going to do a program here right after Labor Day, beyond sometime in September on Medicare, which is a healthcare issue. So those are things that are important. Managing the healthcare costs in your life go a long way to creating a legacy for you and your family in the easiest, best kind of way possible. So ladies and gentlemen, it's been fun talking with you today. I hope this has been a good time for you. Please give us a call, 616-301-2581. We can help you with dealing with living a long time, market volatility, inflation, taxation, and perhaps how to make sure that if there's anything left when you're gone, it gets passed on to your family in the best way possible. So I have a blessed Sunday. Take care, drive carefully, and talk to you soon.
And give the folks at Cornerstone Retirement Partners a call. They are looking forward to hearing from you, talking with you personally, helping in any way they can in making sure you have a plan to achieve your important financial goals. 616-301-2581, 616-301-2581. Take care, everyone. We'll see you along the way on your course to retirement.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured